Why the stock market is so high while the economy is collapsing, the great financial illusion. If you have been following the economy and markets recently, you have likely asked yourself the same question that millions are currently asking. How can the stock market be skyrocketing while everything else appears to be in a state of disarray? Layoffs are increasing, prices are increasing, and small enterprises are closing. Nevertheless, the S&P 500 continues to establish new records. In reality, this is not a mystery. It is an illusion that has been meticulously constructed, a product of the psychological apparatus of capitalism, corporate strategy, and monetary policy. Let us reveal the truth about the great financial illusion, the disconnect between Main Street and Wall Street. At first inspection, the economy and the stock market appear to be measuring the same thing, prosperity. However, they do not. The economy embodies the lived experiences of millions, including wages, employment opportunities, and living expenses. Investor confidence in future profits is reflected in the stock market. Those two have the potential to diverge, and at present, they are at their most distant. Companies can increase stock prices by reducing costs, automating tasks, and repurchasing their own shares, all of which do not benefit employees. During the pandemic, the Federal Reserve's loose money policy resulted in a flood of liquidity into the markets, which sparked a tide of speculative optimism that never truly dissipated. Therefore, investors are celebratory of their record valuations, even though families are experiencing financial hardship due to rent. Power of central banks. The illusion has been primarily driven by central banks, which have discreetly assumed this role. The financial markets have been transformed into an artificial ecosystem by the Federal Reserve and its global counterparts, in which interest rates and money supply are more significant than traditional business fundamentals. Borrowing becomes more affordable when the Federal Reserve reduces rates. The prices of stock are further inflated as corporations incur additional debt to repurchase it. The demand for returns has led investors to accumulate equities as savings accounts and bonds are no longer providing sufficient returns. The outcome? A fake boom in which asset prices increase while the real economy scarcely moves. In the interim, inflation subtly diminishes people's purchasing power. Therefore, although your portfolio may appear robust, your grocery bill may reveal a different narrative, the function of technological giants. The illusion is further compounded by the dominance of a small number of technology titans, including Apple, Microsoft, Nvidia, Amazon, and Alphabet, whose combined market capitalization exceeds entire sectors of the economy. Due to automation, digital products, and AI-driven efficiencies, these organizations capitalize on scalability. Their profits can increase regardless of global demand decreases. Therefore, the Magnificent Seven continue to inflate the indices, even though traditional industries such as manufacturing or retail are experiencing pressure. The market appears to be experiencing growth to the untrained eye. However, it is merely a small number of organizations that are responsible for the entire illusion. Corporate buybacks, the driving force behind artificial growth. One of the most potent and least comprehended drivers of market inflation is stock buybacks. Companies artificially increase demand and reduce supply by repurchasing their own shares with profits or borrowed funds. This results in an increase in share prices, which is beneficial for shareholders and executives whose compensation is contingent upon these figures. However, there is a catch: that money could have been allocated to debt reduction, innovation, or employee compensation. Rather, it perpetuates a temporary illusion of prosperity that maintains the market's upward trajectory while the real economy remains stagnant. The new retail revolution in speculation. Retail investor conjecture is an additional factor that sustains the illusion. Trading has become a cultural phenomenon as a result of platforms such as Robinhood and TikTok finance influencers. Massive volatility is being generated as a result of the purchase of fractional shares and options by millions of individuals who lack adequate knowledge of the fundamentals. In a sense, the stock market has evolved into a form of entertainment, deviating from its original purpose of providing financial support to businesses. The outcome? A casino economy is one in which the victors are determined by momentum, hype, and algorithms, rather than productivity or value creation. Globalization in the transformation of real wealth. Global supply chains continue to enrich corporations that operate internationally, despite the fact that Western economies are grappling with inflation and job insecurity. Production occurs in regions that are less expensive, profits are reported offshore, and taxes are reduced by exploiting legal exemptions. Therefore, the fact that the U.S. stock market has reached all-time highs does not necessarily indicate that American workers are doing better. Rather, it indicates that American companies have effectively exploited global inefficiencies. Real wealth has discreetly transitioned from labor to capital. Workers transition to proprietors, from a large number to a small number. The delusion of debt. The illusion is also being perpetuated by governments worldwide. Even though trillions in stimulus packages, quantitative easing, and debt issuance have prevented economies from collapsing, there has been a cost. Despite the fact that public debt has reached unprecedented heights, investors remain at ease due to the consistent assurances of support from central banks. However, this is a perilous endeavor. Interest payments consume an increasing portion of national budgets as debt accumulates. The limits of fiscal reality will eventually collide with the illusion of infinite liquidity. In essence, the system is operating on borrowed time and borrowed money. Why individuals continue to believe? Psychology is extensively involved in the perpetuation of the illusion. Despite the fact that their actual purchasing power has not changed, individuals experience a sense of prosperity when markets increase. The illusion is maintained by a feedback cycle that creates spending and confidence, which is fueled by the wealth effect. Additionally, it is reinforced by the media. Headlines commemorate record-breaking success whenever an index reaches a new high, even though the majority of households are reducing their expenditures on essential items. The stock market has become a symbol of optimism for many, providing a narrative of recovery that aids in the management of economic uncertainty. However, stability is distinct from optimism. Defects in the illusion. There are already indications that the illusion is beginning to dissipate. Consumer sentiment is at its lowest level in years, debt defaults are on the rise, and corporate earnings are declining. For months, the bond market has been emitting warning signals, which are frequently a more accurate reflection of economic reality. Even investors are beginning to doubt the permanence of valuation separation from fundamentals. The illusion can only be sustained for a limited time before confidence is compromised. The correction will be immediate and severe when it occurs. What is the subsequent step? If history teaches us anything, it is that every illusion culminates in consequences. The inquiry is not whether it will occur, but rather when. We may observe a transition to tangible assets, such as energy infrastructure, commodities, and metals. Political pressure for wealth redistribution may also emerge as more individuals recognize the system's distortion. However, there is also an opportunity for reform, an opportunity to establish a novel economic model that emphasizes long-term value over short-term speculation, one that benefits individuals rather than portfolios alone. The great financial illusion exposed. The stock market's record highs in the context of an economic catastrophe are not indicative of resilience. They are indications of imbalance, a structure that is constructed on the foundation of psychological manipulation, speculation, and debt. We are not experiencing prosperity, it is the manifestation of prosperity. Eventually, the curtain will descend, as it does with all performances. Before you depart, if you found this analysis to be enlightening, please remember to like, share, and subscribe for additional in-depth analyses of the financial forces that are influencing our world. Maintain a critical mindset, remain informed, and never accept the illusion at face value.